Hello and welcome to Morning Markets. I'm Matt Scooby. Here are some stories that we are tracking for you in the BNN Bloomberg newsroom. Oil prices surging today after U.S. President Donald Trump said strikes in Iran will continue. In a primetime address delivered last night, Trump said U.S. forces have significantly weakened Iran, calling the military campaign unstoppable. However, Trump did add that operations will continue until objectives are fully met. The U.S. president also threatening to strike Iran's electric generating plants again if a deal is not reached. Canada's trade deficit widened sharply in February, missing expectations. Statistics Canada says the trade gap grew to $5.7 billion. It's the largest since August. The move came as imports jumped to a record high, driven largely by a surge in gold purchases from the U.S. Imports of metal and mineral products also climbed more than 45%. And Deloitte is cutting its forecast for Canada's growth. In a report, the firm slashing its growth forecast for Canada's economy by 20%, predicting real GDP set to grow just 1.2% this year. Now, Deloitte says soaring energy prices are linked to the war in the Middle East and will weigh on consumer spending, as well as businesses, and further impact economic challenges and uncertainties, ranging from foreign trade to a soft labor market. Let's have a look at the markets, shall we, and how things, again, are looking right now. Things have rebounded somewhat, which is, again, at least good news. The TSX right now up over 100 points, which we did not see and we're not expecting necessarily after what we heard from Donald Trump last night. But in the green, at least for now. South of the border in the U.S., where things, again, relatively, again, down a little bit. The S&P now dipped below and it's showing red once again. But these were significant losses earlier when the markets opened, again, not too long ago. Now things, again, have rebounded somewhat. We'll see what happens here over the next couple of hours. Well, our first guest this morning says that March is on track to be the worst month for the U.S. markets in years. Let's get her perspective on why, along with some of the other market trends. Joining us, Melissa Brown, Managing Director of Investment Decision Research at SimCorp. Melissa, thanks for being here.
My pleasure.
Let's talk about March. We're into the beginning of April right now. The amount of volatility has been exceptional, I think, even, given the war in Iran and we unexpected nature, at least, of that. But give us your sense from last month, too, and how far off and why it has been one of those worst months that we have seen, again, in years for U.S. markets.
Well, it was on track to be one of the worst months in many years. It did pick up on the 31st, so it didn't end up being quite as bad as it had looked on the 30th. But it's still, I think the rising oil prices really put a big damper on expectations for inflation, corporate earnings, consumer confidence. And I think that all weighed pretty heavily on stocks. So the month, while it picked up the last day, was still a pretty bad month.
Yeah, it was really tough. And it was really tough, I think, for, right across the board. Clearly, we have the geopolitical situation with what's happening in the Middle East, the Strait of Hormuz closed. You talked about rising oil prices up again today after less certainty, I think, than we were expecting from Donald Trump last night. Is that the main reason for you, clearly, given that conflict right now? Or what other factors here impacting the market necessarily last month?
Yeah, I think that was probably the main factor. You also did have the I don't want to call it a falling apart, but the AI trade that, was kind of losing some of its luster. So you had, obviously those stocks also and because they're such a big part of the market in the U.S., they really pulled the market down by quite a bit. But the losses were really across the board. The only sector in the U.S. market that did well in March was energy. Everything else was down, suggesting that the oil price concerns were pretty broad-based. Expectations were that higher prices were going to impact all sorts of sectors.
Yeah, and we talk about the price of oil up again today, and just say on that, just because, again, we were, and I think investors expecting a little more clear messaging, I think, from Donald Trump last night. It was a speech in prime time when the conflict was going to possibly end in the Middle East. we didn't necessarily get that. So how are you going to see that? And again, your analysis, at least at this point, what we're looking at, because Donald Trump also talked about the possibility of an escalation here over the next couple of weeks before the U.S. military meets its objectives, which is clearly going to keep that price of oil very high.
Yeah, and I think that, and the uncertainty of the time frame, I think, is what's really the biggest issue. If you remember, it was just a year ago that the Liberation Day tariffs were announced. Those were backed off very quickly. So we had, an initial reaction that was similar to what we've seen in March, but then there was an end. There, you had a backstop, and the market recovered from that point. I think that the uncertainty about the time frame is a big issue because we're going to start to cut into second quarter earnings, and the longer that oil prices stay high, the worse it is for the consumer. I think that there's so many issues that are really weighing on the market that having an end point would have been, I think, much better for investors to know about.
Yeah, and I think we saw that this week, though, haven't we? The last couple of days where there was, the possibility about an end to this conflict, where it was rumored, and we saw the markets respond very much in a positive way.
Yeah, absolutely. I think markets want to be positive. They want to have good news. And they want to have a reason to buy. Although I would also point out that the rebound over the last couple of days was on relatively low volume. So I don't think you were getting a surge of investors back into the market. I think there were some optimistic investors who were buying, but it wasn't the entire investing public. And so I think that makes a difference. And it also suggests we still have pretty negative sentiment in the market. Mm-hmm. So when the news wasn't as good as expected yesterday, I think that's why we had at least the initial reaction this morning.
Yeah, that's fair. I totally take your point on that. I want to ask you, too, about the jobs report that is coming down tomorrow, the first that we have seen since the war in Iran began, but also on a holiday. So the markets are going to be closed tomorrow as well. How are we affecting? What are we going to see? Because, again, the first two jobs reports for the start of this year have been all over the place for the U.S.
Yeah, well, I mean, the expectations are for decent job growth, certainly not knock your socks off, but growth should be positive at least. And I think what the implication of that is that the Fed maybe has to worry less about the employment situation and can turn its focus a little more to the potential inflation caused oil prices. So if that means the Fed is, there's the potential for higher rates coming out of the Fed, typically the market doesn't like that. So we might get that kind of an anomalous move of good jobs report, but bad reaction because of what the Fed might do. But of course, we won't see that till Monday. It's several days between Friday and Monday, and so things could change with oil prices or with what happens with the war. So we might not see the reaction that we would have seen if the market was open.
Yeah, that's fair. And again, we'll see. It's a kind of strange situation, it feels like, for a jobs report again when the markets won't have a chance to react for a couple of days. Melissa Brown, Managing Director of Investment Decision Research at SimCorp. Melissa, appreciate your time today. Thanks so much for this.
My pleasure.
Well, up next, we're going to zero in on U.S. President Donald Trump's speech last night, too, where he delivered very much a mixed message on the conflict in the Middle East. Stay tuned for that after this. The U.S. is raising concerns over Canada's Buy Canadian policy, calling it a trade irritant as cross-border trade talks continue. CTV's Mike LeCouture has more.
The country's iconic symbol of democracy will soon be protected by Canadian steel. During the next phase of renovations, the Peace Tower will be encased by steel scaffolding from Hamilton-based Walters Inc. But it may not have happened if not for the Buy Canadian provision.
It would have been more difficult, and the chances are that much of the material, at least the raw material, would have come from the United States as opposed to from Canada.
As of December of last year, the government mandated that publicly funded infrastructure projects should prioritize Canadian workers and industries. Even though the U.S. has a similar provision, the American trade representative cited Canada's version as a trade irritant. The Minister for Canada-U.S. Trade downplayed the list of irritants, saying talks are continuing.
There was a high-level meeting this week in Washington between senior officials from Canada and the United States to discuss these and other issues. So none of this is surprising to us.
The removal of American liquor off many provincial store shelves is also on the list of irritants, as is Canada's Online Streaming Act and the supply management system, which restricts the import of American dairy, poultry, and eggs into this country. Meantime, Mexico is seemingly further ahead in trade negotiations with the U.S., engaging in technical discussions with the Americans.
I think the Canadian government is stalling for time. They think that Trump, my guess is they think Trump is weak. They want to sort of see if they can get this deferred into the midterms.
Minister LeBlanc says he'll continue to speak regularly with his American counterparts about the CUSMA review, even as the deadline to decide the deal's fate is just 3 months away.
Yeah, CTV's Mike LeCouture reporting for us. Now, U.S. President Donald Trump addressed the nation and the world and sent mixed messages about the war that the United States and Israel launched against Iran more than a month ago. In his speech, he said the war was, quote, nearing completion, after repeating that the U.S. might also escalate by hitting Iran's power plants if there is no deal reached to end the conflict. For more, we're joined by CTV's Kamal Karamali. So, Kamal, certainly, again, not what we were expecting necessarily, what a lot of people were expecting to hear from Donald Trump last night. Take us through some of those mixed messages and a lack of a clear timeline to end the conflict.
Yeah, exactly that, Matt. Critics and Democrats immediately chiming in, calling it a contradiction. On one hand, saying that the war is coming to a close in some sense, but also then saying that there's going to be an escalation for the next 2 or 3 weeks, sending, quote, in Trump's words, Iran back to the Stone Ages where they belong. He spoke about how that there's the potential of them striking energy systems and targeting oil infrastructure as well. But then he also touted success in the ongoing assault on Iran, saying the U.S. is winning but not done yet. The war is, quote, nearing completion. And so he spoke, he took this opportunity, this very, very primetime TV real estate to address the nation, talking about how the U.S. has heavily destroyed Iran's Navy and Air Force, claiming they have been severely damaged in terms of their missile capabilities and their nuclear programming. But as you mentioned, a lot of people saying this may have been a waste of time because he's been saying that over and over and really didn't provide any clear solutions or a timeline to a close to this conflict. Have a little listen to a little snippet of what Trump had to say late last night.
Yet if during this period of time no deal is made, we have our eyes on key targets. If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, because it would not give them even a small chance of survival or rebuilding. But we could hit it, and it would be gone, and there's not a thing they could do about it. They have no anti-aircraft equipment. Their radar is 100% annihilated. We are unstoppable as a military force.
And once again, Matt, no clear timeline on what a victory looks like or what any diplomatic solutions would look like either. Just once again touting some of the successes in his view.
Yeah, a lot of the same lines that we've heard from the U.S. president before. Now, he also did mention too as well, Kamal, that he's threatening to pull out of NATO, which is a bit more of a process necessarily than him being able to do it himself. You know, where does that threat stand and the viability of it, at least for now, to our understanding at this point?
Yeah, very critical critical of NATO earlier in the day in an interview, but then once again reiterating his displeasure with the Transatlantic Alliance, talking about how they're a paper tiger, implying that they're weak, but also talking about how they've not stepped up to support the United States in its campaign against Iran either, Matt. So talking about and threatening to now pull out of NATO, saying that they have not backed the United States, they have not provided any troops or any other resources in this war against Iran. But then once again, placing the blame of the blockage at the Strait of Hormuz, that key shipping corridor for oil and gas, and why gas prices and oil prices have skyrocketed, blaming that blockage on NATO not stepping up. So a lot of critics are saying, look, this is just Trump passing the buck for a war he started, and we'll see where it goes next in terms of what he can do. But right now, critics are saying this is not a possibility because there is a law that Congress passed about 2 years ago not allowing unilateral NATO withdrawal. So whether he can do that, still questionable.
Okay, Kamal Kermali in the CTV News newsroom for us today. Thanks for this, Kamal. Appreciate it.
Anytime, Matt.
Well, coming up, today's market drivers with BNN Bloomberg's Monique Malima, which includes Sigma Lithium sealing a major deal. We'll have details on that and more when we come back. Stay with us. Well, now it's time to take a look at today's market movers. We're joined by Bloomberg Equities reporter Monique Malima. Monique, thanks for being here.
Thanks for having me.
Let's get into it, shall we? Sigma Lithium inking a pretty significant deal, a $100 million deal with a bank in Brazil. What do we know and again, some of the impact on that?
Yes, so Sigma announced today that they reached a $100 million collateralized bank guarantee for a new production facility, and that's really helping to lift the shares today. Shares were up 20% on this news, as it's really helping the company to be able to expand its production and also helping with liquidity as well, providing funding. The company also announced recently that they got a $50 million prepayment from one of their customers, and with these two combined, this is really helping to kind of assuage investor concerns that they had recently around some of the liquidity crunch that Sigma was facing. And as a result of this, Bank of America actually upgraded the stock today to a buy, saying that the liquidity is really improving, and this is also showing that customers and other stakeholders see the value in Sigma and see that this company is going to be able to get back to normal operations and really turn around.
Yeah, certainly interesting too, and on both of those fronts for that company. Let's talk about AI tied into a new Chevron deal as well, the possibility of opening a gas plant in Texas. What are the details there?
Yes, so Chevron reached a deal with Microsoft to power data centers, and that was helping to lift their shares yesterday, and we're seeing some of that fall through today. They're also higher on the rise in oil prices that we saw today, as the U.S. indicated that maybe the Iran war won't be ending as soon as some people had been anticipating. And analysts at Melius Research also said today that Chevron really is expected to be one of the biggest beneficiaries of this rising demand for gas. We've seen supply constraints out of the Middle East due to the attack on a facility in Qatar, and they're saying that could impact supply for years to come. And Chevron is really leveraged to gas compared to some of its peers, and gas is especially important, like you mentioned, when it comes to data centers. Gas is still being used to power a lot of these AI data centers, and that's an area that's just going to be expecting to grow for demand.
Yeah, going to be a lot of demand there clearly here over the next little bit. We talk about upgrades, and for a target, Vail also getting one too from the Bank of America. Take us through that one.
Yes, so Vale was upgraded today. Their shares have been struggling recently on the impacts of the Iran war. To be able to produce, they use a lot of fuel and diesel, and those prices have been rising higher as there's been supply constraints out of the Middle East. But analysts at Bank of America actually say that Vale is well positioned to be able to handle this. The company is expected to grow its copper production, and they're also seeing higher prices for their iron ore right now. And that's going to be able to help to offset some of these higher costs they have in other areas. Another area that's seen increasing prices is freight, which we're seeing across the mining industry. But analysts note that for Vale, they actually have a lot of long-term contracts for their freight operations, so they're not going to see the same level of impacts of these higher costs. So they think that now that the shares have declined, that maybe it will be able to rise again.
And quickly, too, American Airlines, not on the other side of this, too, at least for now, just getting a slight trim, too.
Yes, so American Airlines, their shares are lower today as the oil prices rise. That also increases the prices for fuel costs. And analysts at TD note that American Airlines is one of the most leveraged airlines to fuel costs. So they're going to see more of the impacts to this than some of their peers. And they think that this is going to kind of constrain the shares in the short term and add some challenges for them. But they do note that if the war does get resolved and if oil prices come back down, that the shares then could rally off of that because they've seen so much impacts.
Okay. Bloomberg's Monique Maliba. Appreciate the insight today, Monique. Thanks so much. Well, coming up, Amazon eyes Globalstar in a potential satellite internet power play. We're going to get more into that on the other side. Finance Minister François-Philippe Champagne has been joined by Bank of Canada Governor Tiff Macklem and Bay Street executives in China. The Canadian delegation is meeting with Chinese officials to build on the diplomatic reset that happened earlier this year. The group includes the chief executives of Manulife and Sun Life and the vice chair of BMO Wealth. The talks are expected to include opportunities in financial services and healthcare. Stellantis is exploring plans to build electric vehicles in Canada with Chinese partner Leapmotor. If the plan goes ahead, it would be the first major Chinese auto investment since Ottawa eased tariffs earlier this year. Discussions are focused on the automaker's idled Brampton, Ontario plant. Ontario Premier Doug Ford says any deal to build EVs in the province would have to use local parts, adding that anything else will undermine Canadian auto workers. And shares of BCE, Rogers and TELUS are seeing some pressure today after the telecom giants got downgraded by TD Cowen analyst Vince Valentini. Valentini says recent strength in the stocks has been due to investors seeking safety from geopolitical uncertainties. He adds that aggressively low pricing seen late in the quarter is not fueling volume growth, but rather churn and negative repricing. A reminder that BCE is the parent company of BNN Bloomberg through its Bell Media division. So another quick check on the markets too right now. The TSX up slightly today, right now just over 100 points. Has topped the 33,000 point though. Again, as we were expecting a little bit of a negative start, things have rebounded to slightly, at least to this point. South of the border, things are mostly still in the red here in the last little bit too, where we saw some again down to across the board, at least not quite as bad as it had been, but certainly still right in and around less than half a percentage point overall. Well, copper prices are seeing a little bit of relief after U.S. President Donald Trump suggested the war in Iran could wind down within the next few weeks. There is still a little bit of uncertainty, but it's a little bit of a rebound. For a broader look at the copper market, we are joined now by Charles Cooper, head of Cooper Research at Wood Mackenzie. Charles, thanks for being with us.
Hi, Matt. Nice to meet you.
You know what? We talk about the supply concerns that are still there clearly and evident, and at least for now, with a lot of demand. You take us through the latest of what you're seeing, at least in the market too, and some of the impacts, at least for right now.
I think, basically when we look at the copper market today, we're looking at the risk and the trade-off between, what's going on in the Gulf at the moment and the general impact on the global economy. Where we have the threat of uncertainty within the Gulf, specifically, a prolonged conflict that reduces our, investors' appetite for effectively a strong global economy going forward. And obviously, Donald Trump's comments yesterday helped to alleviate some of the concerns that maybe we could be looking at perhaps some form of resolution or end to the conflict, which is taking some of the pressure off the market, global uncertainty, and that is bringing us back to where we were towards the end of last year, where copper prices were basically moving upwards on the fear of a lack of supply and strong demand.
Yeah, again, a lot of that demand, too, that's there. China is key to the copper market, is it not, at least for right now, and some of that global demand? Take us through at least some of the reasons why.
Absolutely. I mean, China basically consumes half of pretty much every commodity, and copper is no different. Obviously, when we look at China, we look at obviously their global economy, the outlook for their new 5-year plan, which is much more consumer-driven than than the sort of the industrial and very heavy growth that we sort of saw in the previous 5-year plans. So there is a sort of a bit of a concern that China's economic growth is starting to stall. And certainly over the next 5 years or so, certainly out towards the end of this decade, we expect China to become effectively flatline in terms of copper demand growth. And that will be replaced by other economies, Southeast Asia, ASEAN countries, and perhaps India as well.
And at least for now, and when we talk about China and just the role that it plays at this point, but that 2 to 3 week timeline from Donald Trump, maybe a little bit of escalation too with the conflict in the Middle East. I'm assuming we are still anticipating some short-term volatility with copper before things maybe start to level out long-term.
Well, I think the market's going to react with a high degree of sensitivity to any news and any statement from the White House. Mm-hmm. And obviously, I think many participants within the market were pricing in a conflict that that may be lasting 2 months. So perhaps by the end of April, early May, we would see some sort of resolution. I think if it goes beyond that, then there will be significant impact on things like oil supply that will trigger potentially much higher oil prices longer term. That could impact the costs of mining and extracting copper and other commodities, but also put a lot of pressure on the global economy and certainly for the demand for copper. Yeah. Perhaps alternatively, it's great news for those people who are looking to purchase their first electric vehicle.
Oh, that's very true. It's a very good point. Let's talk about Ivanhoe Mines if we can too. That they have, they're seeing some pressure. They cut their guidance on its flagship mine in the Congo. For you, and that happening right now feels like a pretty conservative strategy. So what do you make of that?
Now, that's interesting. I mean, obviously, Ivanhoe and a number of the copper miners, their share prices have sort of fallen over the last few weeks, really on the sort of the kind of the risk trade of what's going on in the Gulf. But the recent update from Ivanhoe underscores the challenges the company faced last year. Back in May of last year, they had a sort of seismic event that took out some of their underground mining operations. And so they came back to the market and sort of with, reduced guidance. Just the last few days, they've cut their guidance even further for 2026, around about 90,000 tons of copper, sort of lower than where they were forecasting. But they're kind of looking to reset their long-term ambitions to grow back to a 500,000 ton per annum producer. And that places them in one of the top top 6 largest copper mining companies globally. But of course, they're going to have to convince investors that they can achieve that again after the sort of the unfortunate events from last year. Yeah,
is that realistic too? Do you think, at least, Charles, at least at this point?
I think that they've done their best to try to reassure the sort of investors with the latest technical reports and updates and engineering studies that sort of suggest that they can slowly rebuild back up to that original target of producing over 500,000 tons. They are in possession of one of the world's largest copper resources. And with potential scale that could take them well beyond that 500,000 ton in the sort of the medium term to long term sort of future, but they need to convince investors and their joint venture partners that the problems that they had last year are one only event.
Mm-hmm. Want to shift just briefly, too, if we can, to wrap up here. Glencore's Horn Smelter, too, as well. Why is that, Horn such a notable asset, too, to the mineral supply chain in North America?
Well, when you look at the midstream processing, of which China typically tends to dominate, having access to midstream processing like smelting, like copper smelting, gives a country an opportunity to sort of extract value, not just from the physical metal that it produces, that goes into the manufacturing chain, into producing copper wire, that goes into sort of, manufacturing of things like overhead hanging wire for electrification. But copper smelters also produce significant byproducts, things like sulfuric acid, that go into the fertilizer industry, or in certain jurisdictions into mining and leaching of copper. But they also produce sort of critical minerals. They, often bound up with the concentrates that a smelter might process from mines that are dotted around the world, will be in train these really, really critical elements that have now appeared on sort of mineral lists for most countries globally. And they become super important if you want to build out your energy transition, or you become much more sort of pure in your own mineral supply chains.
Yeah, certainly interesting, too, as you get into some of the offshoots of that. Charles Cooper, head of Cooper Research at Wood Mackenzie. Appreciate your time today, Charles. Thank you.
Thank you very much.
Well, coming up, Amazon, again, eyeing Globalstar and that potential satellite internet power play. We're going to have more on that as their stock is up over the last couple of days on news of that. Stay with us. Well, shares of Globalstar surging today amid reports that Amazon is in talks to buy the satellite company. While negotiations are still ongoing, a deal could strengthen Amazon's satellite internet ambitions through its project Amazon Leo, positioning it to compete more directly with Elon Musk's Starlink. Here to break it all down is Greg Pendy, aerospace and defense analyst at Clear Street. Greg, thanks for being here.
Thanks for having me.
This is fascinating, I think, to me, too, as we find ourselves where Starlink is, what could happen with SpaceX and the pending IPO. I think it's a separate conversation, clearly. But give us an indication, why Globalstar, why it makes sense for them right now and for Amazon, especially as it tries to close that gap with Starlink.
Yeah, no, Amazon's definitely behind Starlink right now in the race. But I think what makes sense to Amazon potentially is we're learning more and more ever since Starlink paid SpaceX Starlink paid $20 billion for EchoStar spectrum. We're learning more and more how important that is. And in addition, AST Space Mobile has secured a large swath of spectrum. So essentially, if you want to get into the direct-to-device game, we're learning more and more how important it is to secure spectrum. And that might be why Amazon is right now approaching this.
Yeah, it feels like, do they need to do this because they're going to fall even that much further behind if they don't acquire Globalstar?
I think that's right. I think that's where they're basically potentially looking at this spectrum. Now, it's going to be very complicated, as we said in our note this morning, simply due to the fact that Globalstar works with Apple.
Yeah.
And right now, the relationship is Apple pays about 95% of Globalstar's CapEx for the satellite constellations, including a new constellation that will be entering in 2028, we think, under our estimates. But in return, Apple uses about 85% of the capacity. The remaining 15% of the capacity is used by Globalstar to service their other customers. But that relationship will be very tricky. Where we see a big opportunity is Globalstar also owns a large swath of terrestrial spectrum.
Interesting. So how big of a hurdle is that? Is that the biggest hurdle, do you believe? It feels like to this deal, but at least moving forward here in the short term.
Yes, I think that the Apple relationship, Apple likes to sell iPhones, and they like to get us to upgrade our iPhones as quick as possible. So that's the way they benefit from this Globalstar relationship is you need an Apple iPhone 14 or higher in order to use the service. So they're trying to get people to replace their phones to use this type of service, and they can benefit tremendously if people are replacing their phones every 2 years instead of every 3 years. So Apple's going to be very important, I think, if Amazon were to take ownership of the entire company, and importantly, that mobile MSS spectrum or the space spectrum. We believe it's much easier for them to unlock the terrestrial spectrum, which Apple has no ties to.
Okay, so so Apple, that's what I was just about to ask you. So Apple doesn't have any ties to the terrestrial one, and that's why it'll be easier?
We believe so. We believe that the terrestrial spectrum, and to be very clear, I mean, the terrestrial spectrum's already working with what we believe is, they say, one of the world's largest retailers. It could be, a Target or a Walmart or anything, but the terrestrial spectrum would be a value, albeit for a different use case, to a company like Amazon, because it's it's a swath of spectrum that's very useful for areas like logistics and warehouse automation. And they own 11.5 megahertz, including the US rights, as well as 11 other countries. So that's a very valuable spectrum. But when you get into the space spectrum, the Apple relationship would complicate things in our view.
Yeah, clearly. And I think, we talked about the hurdle that it's going to face. Amazon asked the FCC for more time to launch over 1,500 satellites, right? By July of this year. Do we know what's holding up that rollout? Would buying Globalstar help them get to that target if that happens here in the next couple of months?
Well, I think you have to separate the two. I don't think so. I think their interest in potentially owning Globalstar is more or less focused on the direct-to-device side of things, not so much a broadband service. So I think the two are a little bit separate. But I think that the reason they are interested in it is we've already seen major players lock down big spectrum deals like AST Space Mobile, which is looking to use that spectrum for their direct-to-device service. And then also more recently and following that, we saw SpaceX go after EchoStar spectrum for $20 billion. So there's really a limited supply. We're seeing other names that hold spectrum also benefit today in trading. But, spectrum is a non-depreciating asset, and there's a limited supply of it. So I think anyone who's looking to engage with a strategy and direct-to-device is looking at what's available for spectrum.
Yeah, and you talk about those players, and we talk about, is this going to be a two-player race here in Amazon and SpaceX? Because you just touched on, there's a couple there that also spectrum that are still in this, and who else could be, in that race or in this conversation?
Absolutely. So another name we follow that we do like is AST Space Mobile, ticker ASTS. And their approach to go to the market is actually very unique. Now they're launching their Bluebird satellites right now. We expect them to be able to commence service in major regions in 2027, but they're working with 50 mobile network operators, and they have relationships with the likes of AT&T, Verizon, and Vodafone. So they're working in partnership directly with the major mobile network operators on a 50-50 partnership split, so that if a company like SpaceX Starlink goes after their mobile subscribers, they will be able to offer a service that is comparable.
Certainly interesting, too, as we talk about that approach. Greg Pendy, aerospace and defense analyst at Clear Street. Appreciate your time today, Greg. Thanks so much.
Thanks for having me.
When we come back, why Canadian brewers say the tax system needs a complete reset. We're going to have more on that after the break. Stay right here. The federal government is extending the cap on yearly increases on the alcohol excise tax for the next 2 years, aiming to help craft brewers and distillers. But our next guest believes that this is not enough to relieve pressure on the sector and is calling for a removal of the tax altogether. For more, we're joined by Richard Alexander, president of Beer Canada. Richard, thanks for being here.
Thank you for having me.
This tax came into effect yesterday, and I know we talked earlier this week, too, about some of the pressures, too, that distillers, that brewers are facing it. For those that may not be familiar with it, just take us through the excise tax and what brewers and what distillers are facing every year.
Yeah, so back in 2016, the Trudeau Liberals decided that they weren't going to put this tax increase to the House of Commons, which is what most people expect happens when there's a tax increase. And since that went in, it was an automatic increase based on inflation. Since that's gone in, we've seen an 18% increase in the tax on beer and other forms of alcohol. And government yesterday just announced that they're going to do another 2% increase this year. And then the following year, they're going to do another 2% increase. So a 20% overall continuing to increase the tax on the product. And we believe that that's not in the best interest of Canadians right now. We still have an affordability crisis. The industry is struggling. We've seen an 18% decline in beer sales in Canada over that same period. And we've been asking the government, say, listen, we're not opposed to taxes. Just open up the House of Commons and have a debate about it so we can consider everything that's happening in the economy.
Yeah, and again, because there are lots of different factors, right, over the last little bit. And I know initially the tax was tied to inflation, and the cap is, how the government is trying to position this is the fact that this is why it's going to be more affordable. But you just touched on it, too, that there are so many different factors in particular that are affecting beer sales, restaurants, and otherwise, too, right now.
Yeah, so government is saying that this is they're capping the tax, but inflation is about 2%. So even without the cap this year, it would have gone up 2%. So it's hard for Canadians to accept that a $14 million increase in taxes on beer in 1 year is helping them with affordability. Or helping our industry survive the Trump tariffs. We've seen breweries. One brewery I've spoken with have seen aluminum costs increase 60% because of those tariffs. And our unions got together. All the unions in the brewing industry got together, sent an open letter, published an open letter to the Prime Minister, saying, "Look, jobs are at risk. You've gone too far with this tax. Volumes are down, and these are good-paying jobs right across the country."
So you talked about the tariffs, too. What are some of the other challenges, too, as well? As you talked about, the unions, at least at this point, too, and some of the job losses that could be there. I'm assuming, too, we've seen numbers in alcohol consumption have dropped significantly as well in the last couple of years.
Yeah, the big driver is what everybody is experiencing. All the viewers will know that the price of everything has gone up. It's a cost of living crisis in Canada. It still remains. The cost of everything is making people make choices that have been different in the past. So those choices are generally that they're going out less to restaurants. We sell a lot of our product in restaurants. That's hurting the mom and pop restaurants. It's hurting the brewing industry. And it's also hurting farmers. So about 90% of beer that's sold in Canada is grain to glass. It's produced here in Canada. We are a Canadian industry. And at a time when we're under threat by the U.S. and by Donald Trump in particular, it doesn't make sense for the federal government to be increasing taxes on a true Canadian product that Canadians love.
And have you gotten any feedback from the government yet, at least at this point? So, they've stuck to the cap, it sounds like, for the last couple of years. But has there been any, at least any softening in any position, at least for now, that they could and might increase, repealing the tax entirely?
Well, we've been talking about this for a number of years, and this year we've been going around with a coalition that we've built with the unions, with grain growers, with other business associations, and it's clear that we have broad-based support across all political parties, all MPs in Ottawa. So the Liberal MPs have been helping us on this. Conservatives are all over at the bloc, the NDP. But this was a decision that was made, I guess, in the Department of Finance and the PMO. And they seem to be willing to continue to increase taxes when sales of our product have dropped 18%. So it's very hard for us to understand the logic behind that. And it's very hard for individual MPs who are trying their best. And I thank them for all their effort around this.
And at least for you, for now, it would make a difference clearly, but do you need to see anything else beyond dropping the tax in order to help some of the suppliers, to help otherwise in the industry at this point?
Well, there are things that our government can control, and there are things that they can't control. Mm-hmm. So Donald Trump deciding to keep that 25% tariff on aluminum is hurting this industry. But they're doing their best to try and get rid of that, and we'll see what happens in the future. But we're still dealing with that massive cost increase. But what they can control is the taxation rates. So why would you increase tax on an industry that's dealing with a Trump tariff on aluminum, where the unions are concerned about their jobs, we're concerned about our employees, mm-hmm. and restaurants and bars are suffering. It's something within their control. They're not taking in any more money because the volumes have dropped. Right. So it's like we're beyond the point of maximum return on this tax. And it's just open it up to the House and let's have a debate with all MPs and see where that lands.
Richard Alexander, President of Beer Canada. Appreciate your time today, Richard. Thanks so much.
My pleasure. Thank you.
Now, Canada's finance minister is leading a high-level delegation in China, joined by Bank of Canada governor and top financial executives. Now, meetings with Chinese officials aimed at advancing the recent diplomatic thaw and exploring growth opportunities in finance and healthcare. Earlier, we heard from Sam LaBelle, portfolio manager at Veritas Asset Management.
The U.S. has backed off of their meetings with China, and it's kind of slipped in there. Maybe this was planned a long time ago, but we slipped in there and started and sent a fairly high-level minister, in the finance minister, Mr. Champagne, to China to have meetings, and accompanied by several of the insurance companies who would like to do a little bit more business in China, Manulife and Sun Life, to be specific. But ultimately, the U.S. has signaled that they will back away from kind of politicking in the Hormuz after the war or conflict ends. They plan to not be as involved, and that leaves a power vacuum. We think China moves in. They're much more dependent on shipping through the strait in terms of oil and other products. And if China is kind of filling that role that the U.S. is backing away from, Canada would like to get a little closer with China. It's sort of under the diplomatic radar a little bit to send your finance minister, but we do note that Mr. Champagne has experience both in trade, as trade minister, and in foreign affairs. So I'm sure that trade and will not be the only thing discussed at these meetings. And generally, it'd be good for Canada to keep the dialogue going with China.
Well, Market Call is coming up next. Today on the show, we have Richard Orell, portfolio manager at RN Croft Financial Group. His focus today is ETFs. Let's have another look at the markets and how things are faring on Bay Street and in Wall Street today. Again, the earlier losses that we did see, again, at the open, when that bell opened, things were very good, down much lower than they were right now. Things have responded a little bit too. Dow Jones still down close to 140 points, at least for now. The S&P 500, NASDAQ also, again, down slightly, at least at this point. Bay Street was in the green a little bit earlier today and remains there, it looks like right now, too. Has touched just off just a little bit, at least for now, but not nearly as bad necessarily as the things could have been. Thanks for watching Morning Markets. We're going to see you tomorrow.